Real estate versus stocks. The real math. Which one will make you more money? Imagine waking up 10 years from today and discovering that the investment you ignored made someone else a millionaire. What's worse, imagine spending hundreds of thousands of dollars on the wrong one simply because everyone around you said it was the safest investment. Some people swear real estate is the fastest path to wealth. Others say stocks outperform everything in the long run. Both sides have data. Both sides have millionaires. But only one question actually matters. Which one puts more money in your pocket after everything is counted? Not the hype, not the motivational quotes, not what your favorite influencer says. The real math. Because once you understand the numbers, you'll never look at investing the same way again. Let's settle this debate once and for all. First, here's why almost everyone gets this comparison wrong. When people compare real estate to stocks, they usually compare returns. That's a mistake, because investing isn't just about return. It's about return after risk, after taxes, after inflation, after maintenance, after fees, after your time, and after opportunity cost. That's the only comparison that matters. Let's start with stocks. Stocks are incredibly simple. You buy a tiny piece of a company. If the company grows, your investment grows. If it pays dividends, you receive income. If the market rises over time, your wealth compounds automatically. Historically, broad stock market indexes have averaged roughly 10% annually over very long periods before inflation. That sounds boring until you understand compound interest. Imagine investing $10,000. If it grows by 10% every year and you never touch it, your money doesn't just double. It starts earning returns on previous returns. That's called compounding. The first few years don't look exciting, but after 20, 30, 40 years, the curve becomes almost vertical. This is why Albert Einstein is often credited with calling compound interest the eighth wonder of the world, whether he actually said it or not. Compounding is the closest thing investing has to magic. But here's what most people hate. Stocks don't make you feel rich. You don't get keys. You don't own a building. You can't drive your investment. There's nothing to show your friends, just numbers inside an account. Ironically, that's exactly why many people underestimate them. Now let's look at real estate. Real estate makes people feel wealthy immediately. You buy a house, you own land, you collect rent, you watch property prices increase. It feels tangible, real, permanent. And that's incredibly attractive psychologically. But here's where things become interesting. Real estate has something stocks usually don't. Leverage. This single concept changes everything. Imagine you buy a $400,000 property. You don't pay $400,000. You might only put down $80,000. The bank lends you the remaining $320,000. Now suppose the property's value rises by 10%. The house is now worth $440,000. You made $40,000. But remember, you only invested $80,000. That's a 50% return on your own money before costs. That's why real estate has created so many millionaires. Not because houses grow faster than stocks, but because leverage multiplies gains. Unfortunately, it also multiplies losses. If property prices fall by 10%, that same leverage suddenly works against you. Your equity can disappear much faster than you expect. This is why leverage is powerful, but dangerous. And that's only the beginning. Now let's compare the hidden costs that nobody likes talking about. Stocks are surprisingly low maintenance. Once you've invested, you can practically ignore them. No leaking roofs, no broken plumbing, no tenants calling you at 2 a.m. because the air conditioner stopped working, no property inspections, no repainting, no replacing appliances. Your investment doesn't care whether you're on vacation or sleeping. Real estate is different. Even if you hire property managers, someone still pays for maintenance. Roofs wear out, pipes burst, insurance increases, property taxes rise, vacancies happen. Repairs never ask if it's a good time financially. They simply arrive. And every unexpected expense quietly eats into your returns. This is why two properties with identical purchase prices can produce completely different profits. The purchase price isn't the investment, the lifetime cost is. Now, here's something that surprises most people: liquidity. Imagine an emergency happens tomorrow. You need $50,000. If your money is in stocks, you can usually sell part of your portfolio within minutes during market hours. Problem solved. But what if your wealth is tied up in one house? You can't sell the kitchen, or the garage, or half the living room. Selling real estate can take weeks, sometimes months, sometimes even longer during difficult markets. That lack of flexibility has a financial cost people rarely think about. And flexibility itself has value. Now, here's where emotions begin to interfere with good investing. Humans naturally love things they can see. A house feels safer because it's physical. You can touch it, walk through it, paint it, visit it. Stocks feel abstract. You own part of hundreds of companies, but you never physically see your ownership. Because of that, many people assume stocks are riskier. But visibility isn't the same as safety. A house can lose value, a neighborhood can decline, natural disasters happen, governments can change regulations, interest rates can skyrocket. Every investment carries risk. The difference is that some risks are easier to notice than others. Now let's do something most debates never do. Let's compare identical investments over 30 years. Imagine investor A buys diversified stock index funds. Investor B buys rental properties. Both invest consistently. Both avoid emotional decisions. Both reinvest profits. Who wins? The answer is, it depends on something almost nobody talks about: behavior. Because investment returns matter less than investor behavior. One investor panics every market crash and sells. Another keeps buying when prices fall. One landlord ignores maintenance until tenants leave. Another carefully manages every property. One investor keeps adding money every month. Another stops investing after 2 years. Same assets, completely different outcomes. That's why the biggest factor isn't always the investment itself. It's the person making the decision. Before we reveal which investment has historically created more wealth under different circumstances, there's one calculation almost everyone forgets, and it completely changes the answer. The calculation is opportunity cost. Opportunity cost is the price of the choice you didn't make. Imagine you have $100,000. You use every dollar as a down payment on a rental property. Sounds smart. But what if that same $100,000 invested in the stock market would have grown even faster over the next 20 years? Or imagine the opposite. You leave all your money in stocks. While property values in your city double because of population growth, new businesses, and limited housing supply. Every investment closes the door on another opportunity. That's why asking which investment is better is often the wrong question. The better question is, what is this investment preventing me from doing? Now let's talk about income. One of the biggest reasons people love real estate is cash flow. Every month, tenants pay rent. Ideally, that rent covers the mortgage, the taxes, the insurance, maintenance, and still leaves money in your pocket. That monthly income feels incredibly satisfying because you can actually spend it. It's tangible. Stocks work differently. Some companies pay dividends, which are regular payments to shareholders, but many successful companies don't pay much at all. Instead, they reinvest profits to grow even faster. So your wealth increases mostly through rising share prices rather than monthly income. This creates an interesting psychological effect. Many investors believe rental properties are making them richer because they see cash arriving every month. Meanwhile, someone holding stocks may actually be building wealth faster without seeing any money hit their bank account. One feels richer. The other often becomes richer. Those aren't always the same thing. Now let's discuss taxes. Taxes quietly determine how much of your investment you actually keep. Real estate offers several tax advantages in many countries. Mortgage interest may be deductible. Depreciation can reduce taxable income. Operating expenses often lower your tax bill. And if you sell strategically, you may delay or reduce certain taxes depending on local laws. Stocks also receive favorable tax treatment in many places, especially when held for the long term. Long-term capital gains are often taxed differently from ordinary income. Qualified dividends may also receive lower tax rates. The important lesson isn't that one always pays less tax, it's that taxes can dramatically change your final return. Two investors earning exactly the same investment return can end up with completely different amounts of money simply because one planned for taxes while the other didn't. Now let's talk about inflation. Inflation silently steals purchasing power every single year. If your investments aren't growing faster than inflation, you're actually losing wealth, even if your account balance keeps increasing. Stocks have historically been one of the strongest long-term defenses against inflation because companies often raise prices as the economy grows. Higher revenues can eventually translate into higher profits and higher stock prices. Real estate also performs well during inflation. As construction costs rise and housing becomes more expensive, existing properties often increase in value. Rental income may also rise over time. This is why both stocks and real estate are considered better inflation hedges than simply leaving large amounts of cash in a savings account. Cash feels safe, but over decades, inflation quietly erodes its value. Now, here's the factor most YouTube videos completely ignore: time, not investment time, your time. Imagine two investors each build a portfolio worth $1 million. The first investor owns a diversified stock portfolio. They spend maybe a few hours each year reviewing it. The second owns multiple rental properties. They spend weekends inspecting homes, meeting contractors, handling vacancies, reviewing repairs, managing finances. Even with property managers, important decisions never disappear. So ask yourself this: if two investments produce similar financial returns, but one demands hundreds more hours of your life, which one actually produced the better return? Time is a currency, and once it's spent, you never earn it back. Now let's address the biggest myth in investing. People say real estate never goes down. History says otherwise. Housing markets have crashed before. Entire neighborhoods have lost significant value. Interest rate increases have frozen housing markets. Foreclosures have surged during economic downturns. The same is true for stocks. Markets crash, sometimes dramatically. Companies fail. Prices collapse. The difference is that stock crashes happen in public every day. You can watch prices move every second. Real estate prices move much more slowly. Because of that, they often feel less risky. But moving slower doesn't mean moving only upward. Every asset has cycles. Understanding that single truth can save you from making emotional decisions during the next market downturn. Now let's answer the question everyone clicked for: which investment actually makes more money? Historically, broad stock market investing has often delivered outstanding long-term returns with relatively little effort. Real estate has also created enormous wealth, especially for investors who successfully use leverage, manage properties well, and buy in strong locations. But here's the real math. Stocks generally offer higher simplicity, greater diversification, higher liquidity, lower maintenance, and excellent long-term compounding. Real estate offers leverage, monthly cash flow, tax advantages, greater control over the asset, and opportunities to increase value through renovations or better management. So which one wins? If you're disciplined, consistent, patient, and willing to leave your investments alone for decades. Stocks are incredibly difficult to beat, but if you understand financing, can manage risk, know how to analyze properties, and can handle the responsibilities of ownership, real estate can accelerate wealth far beyond what most people imagine. The truth is, many of the world's wealthiest investors don't choose one. They use both. Stocks provide liquidity, diversification, and effortless compounding. Real estate provides leverage, cash flow, and tangible assets. Together, they complement each other's weaknesses. And that's the lesson most online debates completely miss. It's rarely about choosing teams. It's about building a system that keeps making money, whether you're working, sleeping, or on vacation. Before you leave, answer this honestly. If someone handed you $100,000 today and you had to invest every dollar for the next 20 years without touching it, would you buy stocks? Or would you buy real estate? Don't just type one word. Explain why. You might convince someone else or even discover a blind spot in your own thinking. Some of the smartest investing discussions happen in the comments, and your perspective could help thousands of people make a better financial decision. Because in the end, wealth isn't built by winning arguments. It's built by making better decisions year after year while everyone else is busy debating.